Right now in India, there are over 900 million people online. I mean, the digital economy is just roaring, generating this level of transactional velocity that is genuinely difficult to comprehend unless you're, watching it happen in real time.
Yeah, the sheer volume is just staggering.
It really is. Yet, if you look closely at the data, a pretty stark, almost impossible paradox emerges for you, the listener, to wrap your head around. Out of the estimated 300 million households in India that are credit active, meaning they're working, they're earning, they're actively participating in this booming economy, roughly 60% of them are just effectively invisible to the traditional banking system. So welcome to our deep dive.
It is a massive structural chasm, honestly. You've got the most advanced digital payment infrastructure on the planet, right?
Yeah.
But it's coexisting with a legacy underwriting system that it still operates like it's 1995.
Yeah, think that.
Millions of people are generating all this economic energy, but because they lack a very specific type of, legacy paper trail, the formal credit system just shuts them right out.
And that exact tension is what we're dissecting today. We're looking at the explosion of India's digital lending revolution. And to anchor this, we are pulling apart the strategic profile and the raw financial data of a pretty pivotal player in this space, OnEMI Technology Solutions Limited, which you probably know better under their brands, Kisht and Ring.
Right. And our mission for this deep dive is to break down the actual mechanics of how Kisht is using alternative data and machine learning to fundamentally rewire credit for the Indian middle class.
It's a huge task.
Huge. We are going to map out the sheer scale of the addressable market they're attacking, dissect their dual-engine business model, and critically, we're going to stress test the high-wire act of managing billions of rupees in entirely unsecured risk. Because operating at this velocity without traditional safety nets, it changes the entire calculus of lending.
Okay, let's unpack this. Because if you want to understand the machine Kisht has built, you really first have to understand the specific geometry of the battlefield they're operating on. When we look at the retail credit market in India, what is the actual architecture of that space today?
Well, visualizing it as a massive pyramid is probably the most accurate way to look at it. The total retail credit space in India is roughly a $500 billion arena.
Right, $500 billion.
Exactly. And at the absolute apex of this pyramid sits the prime banking sector. This is the territory of, salaried corporate employees working for multinational companies.
The people with decade-long CIBIL histories.
Yeah, substantial property portfolios, impeccable audited tax returns, all of that.
Basically the demographic that every major legacy bank is just fighting to the death over.
Fiercely fighting over, yeah. The major banks will compress their margins razor thin just to capture that top tier, because the impairment risk is virtually zero for them.
They get the lowest interest rates, the dedicated relationship managers.
Pre-approved mortgages, all the perks. But that apex is a remarkably small fraction of the actual Indian population. Now, if you pivot and look at the absolute base of the pyramid, the financial landscape there is completely different.
That's where you see the microfinance institutions, right?
Right. Microfinance, joint liability groups, state-sponsored subsidy programs, and honestly, a massive network of informal, unregulated local money lenders.
And the ticket sizes down there are tiny, but the interest rates from those informal lenders, they can be astronomical.
Oh, yeah, punitive. Absolutely punitive. But between that heavily contested VIP section at the very top and the microfinance layer at the bottom, there lies this fascinating economic anomaly. The missing middle.
The missing middle.
Yeah, it's this vast, sprawling demographic that is just too large, too mobile, and too complex for traditional banks to underwrite profitably using their old legacy methods.
Let's quantify that missing middle for a second. The source data points specifically to personal loans, which is the foundational product for Kisht. The total addressable market, the TAM, for personal loans in India is currently estimated between rupees 25 to 35 trillion.
Which is just a staggering pool of demand.
It's massive. It represents about 15 to 20% of the entire retail credit sector. But the data reveals that formal lenders are currently serving only 20 to 25% of that TAM.
Right, which means you have up to 80% of a rupees 35 trillion market sitting entirely unbanked or, severely underbanked.
That's incredible.
And the crucial element for you to grasp here is that this unserved market is not stagnant. It is expanding aggressively because of these converging macro tailwinds. Just look at the digital velocity.
Yeah, the UPI numbers are insane.
Exactly. As of April 2026, UPI is clearing 15 billion transactions in a single month. That is not just money moving. That is 15 billion distinct data points being generated every 30 days by people who previously operated exclusively in cash.
That digital footprint is entirely new. I mean, 10 years ago, a street vendor or a small independent contractor left effectively zero trace of their economic activity. Today, every single time they scan a QR code, they are building this shadow financial ledger.
Yep. You combine that digital velocity with the demographic reality, right?
Right.
You have an engine of over 400 million working age individuals, primarily between 18 and 35.
And they're concentrated heavily in Tier 2 and Tier 3 cities.
Yes, exactly. Furthermore, the Indian economy is absorbing roughly 12 million new entrants into the workforce annually. The aggressive push toward formalization, spearheaded by initiatives like the Yantan Yohana, which injected 500 million bank accounts into the system, has totally set the stage.
The infrastructure is built, the data is flowing.
It's flowing fast.
So within this rupees 35 trillion void, who exactly is Kisht underwriting? Because we're not talking about funding corporate mergers or building high-rise apartments here. Kisht is targeting the emerging middle class, focusing on personal loans that range from rupees 30,000 to rupees 2,000.
And those loan sizes are highly deliberate. A rupees 50,000 loan might seem like a rounding error to a Tier 1 bank, but for the borrower Kift is targeting, it's highly consequential capital.
Right, it bridges the gap for major life friction points. We're talking about funding a wedding, managing an acute medical emergency, doing critical home repairs, or, allowing a small merchant to buy bulk inventory ahead of a festival season.
Exactly. But if that merchant, armed with a perfectly viable business and solid cash flow, walks into a legacy bank branch in a Tier 2 city and asks for rupees 50,000, the system fundamentally rejects them.
It's wild. Why exactly?
It rejects them because the traditional banking business model just cannot sustain the administrative friction.
Right.
To underwrite a loan, a legacy bank requires a literal mountain of physical documentation.
We're talking 3 years of formal income tax returns.
Salary slips generated by an incorporated entity, verified utility bills, and almost inevitably, a physical asset to pledge as collateral. Processing that paperwork requires human labor, it requires physical branch infrastructure, and it takes time. If it costs the bank roughly the same amount in operational overhead to underwrite a rupees 50,000 loan as it does to underwrite a rupees 50 lakh loan, the unit economics for the smaller loan completely collapse.
Right. I like to think of the traditional banking system as this highly exclusive club with a very rigid bouncer at the door. Millions of Indians have the economic capacity to pay the entry fee, They're earning, they're reliable, they have the cash flow.
Absolutely.
But the bouncer only recognizes one extremely specific type of ID, the legacy paper trail. And if you don't hold that specific ID, you're just left standing on the sidewalk, completely locked out of the formal economy, regardless of your actual credit worthiness.
Yeah, the friction is the feature there, not a bug.
Mm-hmm.
It was designed by legacy systems to keep risk out, but in doing so, it has basically kept a massive engine of economic growth sidelined.
Since traditional banks are relying on heavy paperwork and collateral to act as the bouncer, how exactly is Kisht managing to safely open the doors for millions of people? How do they bypass the bouncer?
Well, they achieve this through a complete 100% digital shift. Kisht has basically engineered an origination platform that strips away physical documentation entirely.
No paperwork at all.
None. The entire onboarding architecture is built around the India stack, specifically leveraging the PAN card and the Aadhaar system.
Ah, the biometric identity layer.
Right. Aadhaar provides the instant biometric and demographic authentication, while the PAN card acts as the hook into whatever formal financial footprint the user has actually managed to establish.
Got it.
By pulling data directly from these digital public goods through APIs, they just obliterate the manual verification process.
And the difference in velocity is genuinely startling. If you look at a traditional personal loan, or certainly anything involving property, the legacy channels can take 30 days just to reach a decision.
Oh, easily 30 days.
Yeah, it involves moving physical folders between departments, manual risk committee reviews, localized branch approvals. It's agonizingly slow.
But Kisht has compressed that 30-day timeline into 2 days for their larger loans. And for their core small-ticket personal loans under the Ring brand, the decisioning and the actual cash disbursement occur in real time.
Instant liquidity, just boom, money in the account.
Instant. And that speed is not just a marketing gimmick, right? It is the core utility of the product.
How so?
Well, if a borrower is sitting in a hospital waiting room facing an unexpected medical bill, or a merchant has a supplier refusing to offload inventory without immediate payment, A 30-day underwriting cycle is effectively useless. Real-time disbursement is literally the only mechanism that solves the economic friction of that exact moment.
Let me push back on this a bit, though, because, I mean, speed does not inherently equal safety. I could build an app tomorrow that instantly wires thousands of rupees to anyone who downloads it, but that doesn't mean I've built a sustainable financial institution. It just means I'm rapidly burning capital.
Fair point, yeah.
Giving unsecured cash to individuals with no established credit history, purely based on digital identity, that seems structurally reckless. Where is the actual risk mitigation here?
And that is the defining question of the digital lending model. If you remove the hard collateral, you have to replace it with something equally predictive. This is where we really have to look closely at the architecture of their proprietary risk assessment engine.
Okay.
They're not looking at a traditional CIBIL score, because for this demographic, the CIBIL score is either non-existent or just too thin to be mathematically significant.
So what exactly is the algorithm analyzing? If I download the Kisht app right now and ask for rupees 40,000, what is the model looking at while that little loading wheel spins for 3 seconds?
It is ingesting and correlating thousands of alternative high-frequency data points, depending on user permissions, obviously, and the operating system environment. The model is analyzing device metadata, behavioral analytics, like how the user physically interacts with the application interface.
Wow, even how they tap and scroll.
Exactly. Plus, historical UPI payment velocity and SMS transaction receipts to sort of map out a shadow cash flow statement. The machine learning architecture processes this vast, unstructured data lake to generate a highly localized probability of default.
That's incredibly advanced.
It is, but here is the critical nuance that many observers miss. The code itself is not the moat.
Wait, really? The algorithm alone isn't the competitive advantage?
Absolutely not. I mean, in 2026, writing a sophisticated machine learning algorithm is effectively a commodity skill. Any well-funded fintech startup can hire data scientists to build a predictive model.
So what's the actual secret sauce then?
The true unassailable moat is the training data. Kisht has been deploying capital and watching how these specific demographics repay since 2016.
Ah, right, a decade of data.
Yes. Every single loan disbursed, every early repayment, every late fee, and every outright default over the last decade has been fed back into the neural network.
The model has essentially learned the specific cadence of the Indian middle-class economy.
They possess institutional knowledge encoded in silicon. A new competitor launching today might have a brilliant algorithm, but their model is essentially just guessing. Kisht's model is drawing on millions of historical loan vintages to recognize really complex behavioral patterns that indicate a willingness and an ability to repay.
Okay, I understand the compounding value of historical data, but from a purely psychological standpoint, an unsecured loan still lacks a physical deterrent. Like if I default on a car loan, the repo agent takes my car. If I default on a mortgage, the bank forecloses on my house.
Right.
If I default on a Kisht loan, I just delete the app. What is the psychological anchor preventing mass delinquency?
What's fascinating here is how Kisht identified and leveraged specific sociological structures to act as a direct behavioral substitute for traditional financial collateral.
Hmm.
They didn't just market to everyone equally, they targeted highly structured micro-communities.
Oh, that's interesting. Give me an example of that targeting.
Look deeply at an initiative they rolled out, called the Sentinel Program. Kisht made a highly deliberate strategic push to offer personal loans to defense personnel and military veterans.
Really, that is an incredibly specific and isolated demographic for a tech platform to focus on?
It's highly specific, yes, and from a risk-weighting perspective, it is an absolute masterclass in alternative underwriting. Analyze the sociology of the Indian military apparatus for a second.
Okay.
First, you have absolute income stability. These are government-backed salaries. But the income is secondary to the psychological component. Defense personnel exist within an extraordinarily tight-knit, disciplined hierarchy. Personal honor, community reputation, and unit cohesion are paramount.
So the social structure itself is the collateral.
Exactly. The Dunbar number applies perfectly here. If a soldier in a specific cantonment defaults on an external loan, the repercussions are not merely a ding on some distant credit bureau file. It becomes a localized reputational hazard.
The social and professional friction of defaulting within that highly structured environment is just massive.
Huge. Kisht recognized that the community's inherent discipline functions identically to a property land.
They replaced the fear of losing a physical asset with the fear of localized social friction. That's brilliant. And the numbers on this are substantial. The sources indicate that by building localized trust and a strong brand presence within this specific vertical, defense personnel and veterans grew to account for roughly 20% of Kisht's entire portfolio.
which creates a remarkably stable anchor for their balance sheet. And importantly, it forms a brand moat that is incredibly difficult for a competitor to breach.
Yeah, I'd imagine so.
A rival fintech cannot simply buy some digital ads and immediately win the trust of a military cantonment. It requires sustained, localized execution, word-of-mouth validation, and a deep understanding of the administrative nuances of that demographic.
So they've got the tech to find reliable borrowers and the speed to win them over, but processing data is very different from managing a balance sheet. How is the money actually flowing? How is the capital structured?
To understand the financial mechanics, you really have to look past the app interface and examine Kisht's corporate architecture. They do not operate as a single monolithic lender.
Okay, what are they doing instead?
They have constructed what is essentially a two-engine machine. It is a highly sophisticated, dual-revenue hybrid model that separates the technology from the balance sheet.
Break down the mechanics of Engine 1 versus Engine 2 for me.
Sure. So Engine 1 is their on-book lending operation. This is housed within their wholly owned subsidiary, Sycriva Capital, which is a fully regulated non-banking financial company, or NBFC.
So Sycriva is the vault. They hold the actual capital, they disperse the loan from their own accounts, and the loan sits squarely on their balance sheet.
Precisely. When Sycriva underwrites a loan, Kisht is taking 100% of the default risk, but they're also capturing 100% of the net interest margin. They reap the full economic reward of the yield.
Got it.
That's the on-book engine. But the true scalability of their model relies heavily on Engine 2, which is the off-book distribution network.
Off-book implies they're essentially acting as a broker, right?
Basically, yes. They act as a lending service provider, an LSP. In this engine, Kisht utilizes its massive user base, its marketing apparatus, and its proprietary AI to acquire the user and price the risk.
Right.
However, the actual liquidity, the actual rupees being wired into the borrower's account, comes directly from the balance sheet of a larger partner institution. That could be a traditional bank or a massive wholesale NBFC like Northern Arc Capital.
Oh, I see. Think of the off-book model like a highly sophisticated real estate broker. Kist finds the perfect buyer, verifies their income, handles all the complex paperwork, and connects them with the seller. For that service, they take a significant commission, but they don't actually have to buy the house themselves. They take no direct balance sheet risk if the roof caves in.
It is a totally capital-light origination strategy. Kisht earns sourcing fees upfront, processing fees, and crucially, performance-linked servicing fees if the loan continues to perform well.
That's a sweet deal.
It is. The brilliance of Engine 2 is that it allows Kisht to scale its revenue and its market share exponentially without being bottlenecked by the need to constantly raise new equity to fund the loans. They can leverage the massive balance sheets of legacy banks who have the capital but lack the digital distribution to reach Tier 2 borrowers.
Let's track how this dual-engine architecture translates into actual financial velocity, because the numbers are staggering. The AUM, the assets under management, shows a trajectory that just defines hypergrowth. In the fiscal year 2023, Kishut's AUM sat at rupees 1,268 crore.
Which is a substantial base, but look at the acceleration. Just under 3 years later, by December 31st, 2025, that AUM had exploded to rupees 5,956 crore.
That is scaling the balance sheet 4.7 times in a 36-month window. And the revenue conversion is equally aggressive. For the 9-month period ending December 2025, Kish recorded revenue of rupees 1,559.9 crore, translating to a net profit of rupees 199.2 crore.
However, a purely linear growth narrative ignores a critical strategic pivot they executed. If you analyze the financial tables closely, you will see a deliberate contraction in the fiscal year 2025. Their revenue actually dropped 20% year over year, falling to rupees 352 crore.
Yeah, I saw that. In a hyper-growth tech environment, a 20% top-line contraction usually signals catastrophic churn. Why did the revenue shrink so suddenly?
It wasn't a failure of acquisition, surprisingly. It was a deliberate amputation of a toxic product line. Kisht made the strategic choice to entirely exit the ultra-short-term personal loan segment. These were loans with extremely short tenors, often just weeks, that carried astronomically high yields.
High yield, but presumably extremely high friction.
Massive friction. While those ultra-short loans generated massive upfront revenue, the impairment costs were brutal. The default rates were highly volatile, meaning the NBFC had to constantly set aside capital for provisioning, which eats directly into operating profit. It was the financial equivalent of a sugar rush. Great for immediate top-line vanity metrics, but highly destructive to the long-term health of the balance sheet.
So they sacrificed short-term revenue to stabilize their risk profile. By stripping out the high churn loans and rotating the portfolio towards slightly longer tenor loans with more predictable repayment schedules, they basically smoothed out the volatility.
They did.
And you can see the validation of that strategy in the December 2025 numbers. The profitability didn't just recover, the fundamental margins expanded.
Yeah, the structural shift allowed their net interest margins to expand significantly, hitting 23.8% in FY25.
A 23.8% INIME is exceptional. That is the core spread between the cost of the capital they are borrowing and the yield they are charging the end consumer.
Beyond the raw spread, you begin to see the compounding effects of operating leverage. Because Kisht is fundamentally a technology platform, a massive portion of their cost structure, the cloud infrastructure, the core ML engineering teams, the regulatory compliance frameworks, it's all relatively fixed.
It's like a toll road. Once the digital highway is built, processing 1 million cars costs marginally the same as processing 10,000 cars.
Exactly the mechanism.
Mm.
As the top-line revenue scaled past that FY25 dip, those fixed infrastructure costs diluted across a much larger AUM base. You see this directly in their cost-to-income ratio, which tightened from nearly 66% in FY23 down to approximately 56% by the end of 2025.
Wow, so the machine is becoming fundamentally more efficient as it grows.
Yes.
Let's establish the architects of this machine, too. The company is led by its two founders. CEO Ranveer Singh has a background anchored deeply in financial services, bringing specific expertise in risk management and large-scale data analytics. Post-IPO, he maintains a 14.4% ownership stake, which values his specific holding at roughly rupees 5.1 billion.
Right. And alongside him is co-founder and CFO Krishnan Vishwanathan. His academic foundation is a B.Tech in electrical engineering from IIT Delhi, followed by an MBA from Yale.
Solid background.
Very solid. His career spans over 18 years across financial services and corporate consulting, including a highly relevant tenure at McKinsey. He holds a 10.4% ownership stake, valued post-IPO at approximately rupees 3.7 billion. So between the two promoters, you are looking at a combined ownership of roughly 25% post-IPO.
So what does this all mean? When you aggregate the pieces, the rupees 35 trillion TAM, the Aadhaar-driven instant underwriting, the dual-engine capital structure, what is the actual strategic position of Kisht today?
It means they have successfully engineered a capital-light customer acquisition funnel that operates at national scale, and they've bolted it onto an increasingly sophisticated balance sheet that knows exactly which risks to hold and which risks to pass to partner banks.
It's an incredibly potent, highly calibrated distribution mechanism. They've clearly mastered the art of the unsecured personal loan to get to this massive scale. But to justify their recent IPO valuation, they have to prove this engine can work on entirely new types of fuel. Growth requires new frontiers. To validate their market cap, they have to prove that their core underlying technology can underwrite entirely different, far more complex asset classes.
And this transition isn't just about chasing higher valuations either. It is an existential requirement. As impressive as their growth has been, the current architecture holds a profound, glaring vulnerability.
Let's talk about it.
As of today, 94% of Kisht's entire loan book consists of unsecured personal loans.
94% unsecured. That is practically a monolith of uncollateralized risk.
It is. To survive the inevitable macroeconomic cycles of the next decade, they must diversify that balance sheet. They are currently executing an aggressive push into two massive, vastly more complex vectors. Vector 1 is LAP loans against property.
Okay, transitioning from an instant rupees 30,000 personal loan to underwriting physical real estate is a massive pivot. What are the dynamics of the LAP market in India right now?
The total addressable market for LAP is colossal. It's estimated at rupees 15 to 20 trillion as of FY25. However, formal lending institutions currently serve only about 30 to 40% of that demand.
Which leaves a 60 to 70% void. We are talking about tens of millions of physical properties, particularly in semi-urban and rural areas, that represent entirely locked, dead capital. The owners have wealth sitting in bricks and mortar, but they literally cannot access liquidity against it.
Because the legacy friction is insurmountable. Securing a traditional property loan in India requires navigating a Byzantine maze of physical paperwork, manual title verification that requires physical visits to local municipal offices.
Bureaucratic nightmares.
Endless delays. The digital penetration in the property loan sector is currently less than 5%.
So how does Kisht apply their digital-first instant approval ethos to a hard physical asset that requires municipal verification? That seems impossible to do in real time.
Well, they're attempting to entirely digitize the property assessment workflow. They're integrating their core underwriting engine with emerging government digital infrastructure,
Like what?
specifically eKYC protocols, DigiLocker for document verification, and the massive ISVAM ITIA scheme, which is actively using drones to map and digitize property registries across rural India.
Drones. Wow.
Yeah. By piping this newly digitized municipal data directly into their risk models, Kisht's objective is to compress the property loan approval cycle from 30 days down to 48 hours.
If they successfully execute that, it fundamentally alters their risk profile. It allows them to rotate that 94% unsecured book by rapidly bringing secured collateralized assets onto the balance sheet.
Exactly.
But LAP is only the first vector. The second expansion vector is arguably the most critical for the broader Indian economy, and that's the MSME sector.
Micro, small, and medium enterprises. These 63 million businesses are the undisputed engine room of the Indian economy. Yet, the credit gap they face is just staggering.
How big of a gap?
The estimated credit demand from the MSME sector is roughly rupees 100 trillion, but the formal banking system is only supplying about rupees 45 trillion.
Creating a massive credit vacuum of rupees 40 to 60 trillion. Why are traditional banks failing to underwrite the very businesses driving the economy?
Because the vast majority of these 63 million MSMEs operate in the informal economy. They do not retain corporate accountants to produce pristine, audited financial statements.
Right.
A traditional bank underwriting model looks at a localized hardware distributor in Jaipur, asks for 3 years of audited P&L statements, and when the distributor can't produce them, the bank declines the loan.
But the macroeconomic tectonic plates have shifted under the bank's feet over the last 5 years. The implementation of the Goods and Services Tax, GST, combined with the absolute ubiquity of UPI payments, has forced these informal businesses to leave a digital trail.
And that is the inflection point. That hardware distributor in Jaipur might not have an audited P&L, but his daily inventory purchases are now logged via digital GST filings, and 80% of his daily sales are instantly recorded via the UPI QR code sitting on his counter.
And Kisht's algorithms are custom-built to ingest that exact type of high-frequency transactional data.
Precisely. They connect via API to the GST network and the UPI ledgers. Instead of looking at a static tax return from 12 months ago, the machine learning model analyzes the merchant's real-time cash flow velocity.
That's huge.
They can see the seasonal spikes, the inventory turnover rate, the daily settlement volumes. Based on that live data feed, Kisht can underwrite dynamic business loans or integrate instant checkout EMIs directly into the merchant's supply chain purchasing flow.
They are essentially underwriting the velocity of the business itself rather than its historical paperwork. But penetrating these colossal rupees 20 trillion and rupees 60 trillion markets requires a completely different magnitude of capital. You cannot build a massive LAP and MSME portfolio solely by acting as a broker for partner banks. You need hard liquidity on your own balance sheet.
Absolutely.
Which brings us directly to the mechanics of their recent IPO. Walk us through the capital they just raised in the public markets.
Sure. So the IPO was executed in the April-May 2026 window. It was a highly scrutinized event in the fintech sector, and it successfully secured rupees 926 crore in total capital.
Let's dissect the structure of that rupees 926 crore.
The composition is critical here. Of that total, rupees 850 crore was generated through a fresh issue of shares. That means rupees 850 crore in hard cash flowed directly onto Kisht's corporate balance sheet.
Right, that's a massive injection.
It is. The remaining rupees 76 crore was structured as an offer for sale, an OFS, allowing early-stage investors such as Temasek-backed Vertex to liquidate a fraction of their positions.
And how did the public markets value the entire enterprise?
The final pricing valued the company at rupees 2,881 crore. Upon listing on the BSE and NSE on May 8, 2026, the stock demonstrated strong institutional demand, debuting at an 11% premium over its established issue price band of rupees 162 to rupees 171.
To understand the strategic impact of this IPO, let's revisit our real estate broker analogy from earlier. For the past several years, relying heavily on their off-book engine too, Kisht has been the ultimate broker. They built a massive network, found the perfect clients, and took a fee, but they relied on the massive balance sheets of partner banks to actually fund the loans.
Correct.
That rupees 850 crore fresh capital injection fundamentally changes their posture. They're no longer just the broker. They now have a massive war chest of their own unencumbered cash to inject directly into the base of Creva Capital. They
Yes.
can start buying the houses themselves, retaining the entire profit margin as they aggressively scale into the LAP and MSME sectors.
The fresh capital fundamentally de-risks their growth trajectory. It provides the heavy balance sheet artillery required to scale those secured asset portfolios without the immediate crushing cash burn that typically accompanies pivoting into new lending verticals.
But driving a massive fleet at top speed on a digital highway comes with severe crash risks. And in this industry, the road is paved with companies that spun out of control.
Oh, absolutely. Which requires us to ruthlessly analyze the structural vulnerabilities inherent in their model.
We have to stare the elephant in the room directly in the eyes. Despite the sophisticated AI, the strategic pivots, the massive TAMs, and the successful IPO, 94% of Kishit's current outstanding book is unsecured personal credit. That is a terrifyingly concentrated exposure to consumer behavioral risks.
It is the biggest risk factor, without a doubt.
Because if the Indian macroeconomic engine stutters, if inflation spikes, squeezing household disposable income, or if Tier 2 unemployment ticks upward, history tells us exactly what happens. Unsecured personal loans are the absolute first obligations that consumers abandon.
It's basic economic triage. When liquidity dries up, a borrower will exhaust every resource to pay their mortgage because they cannot afford to lose their shelter. They'll prioritize their vehicle loan to ensure they can physically commute to work.
Yeah, that makes sense.
But an uncollateralized loan from an application on their smartphone, that falls to the absolute bottom of the repayment hierarchy.
It is the ultimate fair weather asset class. When times are good, the yields are beautiful. When times are bad, the capital evaporates. What is the current reality check on their asset quality right now?
As of the data ending December 31st, 2025, their gross non-performing assets, the GNPA, stood at 2.9%.
In the context of a 94% unsecured portfolio, how should an analyst interpret a 2.9% GNPA? Is that high? Low?
It's an elevated figure compared to prime secured lending, certainly, but within the specific risk weighting of their high-yield model, it's entirely manageable. Their 23.8% net interest margin easily absorbs a 2.9% default rate while leaving a healthy operating profit.
Okay, but what if things go south?
The stress test scenario is what defines the systemic risk. An acute macroeconomic shock or a sudden liquidity crunch in the NBFC sector could rapidly cause that 2.9% to double, pushing GNPA into the 6 to 10% range.
Walk through the financial mechanics of that scenario for us. If GNPA suddenly spikes to 8%, what happens to the income statement?
It creates a massive cascading impact. When loans shift into the non-performing category, the regulatory framework requires the NBFC to aggressively increase its provisioning. They must legally set aside vast sums of their own capital to cover the anticipated losses.
Wow, okay.
And this impairment cost is subtracted directly from their operating profit. In an unsecured portfolio, a rapid spike in GNPA to 8% doesn't just reduce margins. It can completely obliterate profitability, stall all future AUM growth as capital is trapped in provisions, and trigger a catastrophic re-rating of the stock.
But the threat matrix isn't limited purely to macroeconomic cycles. The most immediate existential threat to the entire digital lending ecosystem comes from the regulator. The Reserve Bank of India, the RBI, has been monitoring this explosion of instant unsecured credit with increasing alarm.
Right, because the RBI's mandate is macroeconomic stability, and they view the rapid proliferation of algorithmic unsecured lending through a highly skeptical lens.
They're not messing around.
No, they are actively scrutinizing the entire sector's architecture. They are aggressively targeting opaque pricing structures where platforms bury exorbitant annualized rates behind complex processing fees. They're cracking down on aggressive or coercive digital collection practices. But the most critical regulatory battleground centers on the mechanics of first loss guarantees.
Explain the plumbing of a first loss guarantee, because this is really where the shadow risk actually lies.
Historically, a digital platform, acting as an LSP, would approach a massive partner bank and propose a deal. They'd say, you provide the capital for these million microloans. In exchange, we guarantee that if the portfolio defaults, we will absorb the first 5 or 10% of the absolute losses directly out of our own pocket.
Yeah.
That is a first loss default guarantee, or FLDG.
So Kishit is essentially providing a synthetic credit enhancement to convince the bank to open the vault.
Yes. But the RBI analyzes that architecture and it identifies immense systemic risk. If a fintech platform is guaranteeing the losses, but that platform does not hold the massive capital adequacy buffers required of a traditional bank,
Yeah.
well, a macro shock could instantly bankrupt the platform, rendering the guarantee worthless.
Suddenly, the partner bank is left holding hundreds of crores of toxic, unsecured assets that they never actually underwrote themselves.
Exactly. It shifts a risk from regulated balance sheets into the shadows.
If we connect this to the bigger picture,
If we connect this to the bigger picture, the RBI is not merely concerned with the survival of Kisht. They're attempting to defuse a potential macroeconomic time bomb. If 50 million newly banked Indians become trapped in cascading cycles of unsecured debt across dozens of different digital platforms, and the platforms lack the capital to absorb the inevitable defaults, the contagion spreads directly into the core banking system.
the regulatory sword of Damocles is hanging by a thread. If the RBI decides to fundamentally alter the rules of the game, if they impose strict caps on the maximum interest rates for unsecured microloans, or if they entirely outlaw the fee structures that LSPs use to monetize the off-book model, Kishen's revenue engine could be slashed by 20 to 30% overnight.
Or if they enforce draconian forbearance mandates during an economic dip, the partner banks will instantly freeze all capital deployment to the LSP channels. The liquidity tap shuts off completely.
And the institutional investors are acutely, painfully aware of this regulatory and cyclical fragility. You can see the anxiety perfectly reflected in the micromechanics of their IPO. We noted earlier that the stock eventually listed at a strong 11% premium. But if you analyze the day one subscription data, the narrative was entirely different.
It really was.
On the first day of bidding, the overall issue was subscribed a mere 0.25 times.
Yeah, and the retail segment was even more hesitant, recording a subscription of just 0.06 times on the opening day.
That initial hesitation is the market staring at a balance sheet that is 94% unsecured and blinking. Investors were actively weighing the explosive growth against the potential for regulatory decapitation or a cyclical default wave. The issue eventually garnered massive momentum and oversubscribed, but that day one data is a permanent record of the market's inherent fear of the unsecured model.
And remember, it's a hyper-crowded, hyper-competitive arena. Kisht is not operating in a vacuum here. They're fighting a brutal war for customer acquisition against over 100 heavily capitalized competitors. You've got legacy behemoths like Bajaj Finserv pivoting hard into digital. You've got massive payment aggregators like Paytm leveraging their ubiquity, and dozens of agile startups all attempting to underwrite the exact same demographic. It often triggers a race to the bottom on pricing and risk standards.
If it's this risky and 100+ competitors are trying to do the exact same thing, why hasn't Kisht cracked yet? How have they managed to not just survive, but scale to a nearly rupees 6,000 crore AUM and execute a successful public listing?
Well, their survival and scale are really predicated on two foundational pillars. The first is an almost obsessive optimization of their customer acquisition architecture. Because of their decade-long data moat and their highly refined multi-channel marketing engine, they can acquire and onboard a verified borrower at a fraction of the cost of a legacy bank or a newer fintech.
They boast over 63 million registered users, right?
Exactly. That sheer volume of top-of-funnel data provides a massive operational buffer against localized defaults and competitor pricing pressure.
And the second pillar.
The overwhelming, undeniable momentum of the Indian macroeconomic transformation. Kisht is currently riding one of the most powerful economic tailwinds in global finance.
The push toward formalization.
Yes, the massive expansion of digital public infrastructure, the exponential penetration of UPI into Tier 3 cities, and the forced formalization of the MSME sector. These are structural forces pushing millions of Indians toward formal credit for the first time. Right now, the sheer velocity of that macro environment is effectively masking the inherent cyclical vulnerabilities of the unsecured lending model.
Which brings us to the ultimate question for you, the listener, as you watch this financial revolution unfold in real time. We have dissected a genuinely remarkable corporate journey today. We examined a platform that launched in 2016 into a fragmented, heavily paper-based ecosystem and aggressively rode the digital wave to construct an AUM approaching rupees 6,000 crore. Kisht has definitively proven that if you deploy enough computational power, ingest enough alternative data, and execute with relentless speed, the massive missing middle of the Indian economy is not just bankable, it is highly lucrative.
Their core achievement is demonstrating that the traditional friction of banking, Their reliance on physical documentation, the necessity of localized branch networks, the rigid demand for hard collateral. It can all be entirely bypassed through the intelligent application of digital public infrastructure and machine learning.
But beneath the massive TAMs and the impressive profit margins, there is a fundamental philosophical tension at the heart of this entire enterprise. Kisht is effectively attempting to digitize trust. They are systematically replacing the localized, nuanced intuition of a traditional community banker and the physical security of a property deed with mathematical probabilities generated by a silicon neural network.
And that raises a profound question. We have to acknowledge that machine learning models, no matter how sophisticated, are trained exclusively on historical data. They learn from the past. But they are operating in India, an economy that is changing at a velocity that defies historical precedent.
Right.
When millions of individuals and millions of informal businesses are entering the formalized digital economy every single month, the environment itself is entirely novel. Can an algorithm built on the data yesterday truly and safely predict the chaotic nuances of human behavioral risk in a macroeconomic landscape that has never existed before?
It is the ultimate real-world stress test of code versus human chaos. Thank you for joining us on this deep dive. Keep questioning the consensus, keep looking past the surface level data, and keep exploring the hidden forces shaping our world. See you next time.